Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of Gati Limited, hosted by PhillipCapital India Private Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikram Suryavanshi from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you, Rutuja. Good afternoon and very warm welcome to everyone. On behalf of PhillipCapital, I welcome you all to 1Q FY23 earnings conference call of Gati Limited. We are pleased to have with us management team represented by Mr. Firoz Shah Sarkari, FIL, CEO, and Mr. Anish Mathew, CFO for Gati Limited. We'll have opening comments from the management followed by question and answer session. Thank you, and over to you, Phil, sir.
Thank you, Vikram. Good afternoon and a very warm welcome to everyone on our Q1 FY23 earnings conference call. We have uploaded our results presentation on the stock exchanges and company's website, and I hope everyone had an opportunity to go through the same. As mentioned, along with me, I have Mr. Anish Mathew, the Chief Financial Officer for Gati Limited, as well as our investor relations team. We started the new financial year on a good note, with our revenues of our core express business increasing by 46% year-on-year and 13% quarter-on-quarter basis, and we have also seen improvement in our margins and profitability. The continuous efforts of infrastructure augmentation, integration of technology for efficient operations, realigning our systems and processes as per the requirements of the business, and moreover, focus on customer delight have been the key pillars to this performance. With this upbeat performance, we expect to further gather momentum entering 2023 with an agenda of outpacing the industry growth rate. On the industry front, we believe that in India, organized express logistics industry would be the fastest growing sub-segment in the overall logistics sector due to the following reasons: increased demand for shorter transit times, specialized handling of cargo, very few capable national players who could manage such hub and spoke network, and increasing e-commerce penetration. There are different numbers pegged to the industry. However, our estimation suggests that the surface express industry would be in the range of 14 to 15,000 crore. And then there is another large PTL and organized trucking industry where express offerings are gaining traction, thereby providing the growth momentum. We have been witnessing the shift from unorganized players to the organized players in the last couple of years. The increasing trend in e-way bill, which are currently at its highest monthly run rate of 7.5 crore, 63% of which is intrastate and balance is interstate, are strong leading indicators of this shift. There has been constant need of more and more integration of technology aimed at providing ease of doing business and gaining customer delight. We believe our Gati 2.0 is on track with the right strategies and customized services which enabled us deeper penetration among the existing customers and addition of new customers. At Gati, we have been speaking of accelerating and enhancing our existing infrastructure to manage higher loads in the most efficient manner with hub modernization and increased automation. We have seen increased volumes and higher throughput at our mega hub at Farrukhnagar with more efficient and lean operations. Similarly, we are going to go live with our Mumbai hub in the current quarter, and we believe that this will add up to the volumes for the coming years. We are also planning similar mega hubs across the country and is planned to go live some in FY23 and some in first half FY24. Post this infrastructure amplification, we will be able to cater to our customers with industry-leading turnaround times, with improved service levels to manage their logistical requirements in an efficient manner with higher OTIF delivery. We have been also speaking of the technological upgradation with GEMS 2.0, which will create a digital bridge between the back-end and front-end operations. We are happy to report that the project is going in full swing and is expected to be completed in the next 12 to 18 months. However, we will be implementing the same in various modules, for which some have been implemented and some are in trial and pilot phases and will be implemented from time to time basis. This digital transition will help us to improve our efficiencies in front-end platforms like sales acceleration, digital payments, data science, and customer service, with enhanced integration with back-end for better, lean, and efficient operations in terms of network decision support, hub optimization, etc. As these modules get implemented, we have now access to real-time data whereby our IT team are able to add analytics with regards to route planning, optimal load planning, improve turnaround times, and reduce cooling periods, thereby increasing our ability to accelerate margins. We have been working on focusing on reducing cost per kg, more engagement with customers for wallet share addition, customer retention, and new customer acquisition. Efficiently planning our infrastructure and hubs to manage flex and peak capacity, thus increasing throughput and achieve scale. Lastly, we have also been focusing on few other ongoing initiatives like pilot run for pickup and last mile delivery using electric vehicles, ease of doing business with Gati for customers from booking till delivery, and also embarked upon CSR activities for our contribution towards the society. With this, I would like to hand over the call to Mr. Anish Mathew, our CFO, for financial and operational highlights for Q1 FY23. Over to you, Anish.
Thank you, Phil. Good afternoon, everyone, and a very warm welcome to our FY23 earnings call. I'll take you through the highlights of financial results for the first quarter of FY23. On revenue front, our consolidated revenue from operations for Q1 FY23 stood at rupees 431 crores as compared to 299 crores in Q1 FY22, a growth of 44% year-on-year.
and have more franchisees that can get us this business. As you know, at one point of time, a few years back, Gati was the leader in the retail business. Over the years, we have lost our leadership there, but we want to regain that leadership. On the SME side, we have engaged ourselves with the SME Chamber of Commerce in India. In fact, we were the lead sponsors of their seminar that was held in Bombay just last month. And we are engaging with them as knowledge partners to the SMEs. We strongly believe that this engagement will help us penetrate the SME segment in a big way.
Okay. And, on the margin side, what has helped the improvement in margins? I mean, other expenses I see have, gone down. Anything that you want to highlight here?
So as you know, gross margins in our business is a combination of yield, weight, as well as reduction of direct costs. And I think as far as we are concerned, for this quarter, there was a very, very strong focus on yield and, of course, optimization of the network. And a combination of these two have got us our gross margin, and we continue to focus on both these.
Okay, and we remain on the target of 9 to 10% for this year margins.
So yes, as we increase our gross margins and top line, we will leverage the cost. As I had said, we believe that we have reached a cost level below the gross margin, which will be now static for the next growth that we envisage in Gati.
Okay, and on the infrastructure launches, it seems that we've delayed Mumbai, Bangalore, Indore, and Hyderabad launches by a quarter. What has led to this delay?
So the Bombay launch should be in September this year. The delay, of course, as you know, is twofold. One is monsoons that have really hit Bombay, and we got delayed in the construction part, but more so it also is a very unorganized sector in B1D. So some surprises keep coming up. However, we are now on track, and I'm sure we will start our third quarter operations from the super hub. Also, Bangalore, we had some issues with the landowners because, as you know, we are leasing the land over there. But all that is settled. I'm sure that 1st January we should be able to start our operations in Bangalore. Having said that, some of them we have preponed to. So, for example, we were lucky in Nagpur, we found a ready facility. So we will be starting our Nagpur new hub again by September. And we also did a similar thing in Gauhati, where we were lucky to find a new hub, which we will be starting in sometime in August and September. So we keep looking out simultaneously. If there is something we find which is ready to use, of course, it will never be in our super hubs. Our super hubs will always be built out. But in the other cities, we keep an eye on something that is ready to use, and we go in and move in there.
Okay, thank you. And lastly, if any update on the reorganization, if at all there is any update or announcement on that. That's it. Thank you.
So the reorganization, as far as Gati is concerned, is complete. And when we say reorganization, I mean the reorganization of the organizational people, right? So I think we have completed the reorganization. We are now well structured both on the sales and operations side, including the top management of the organization. So I would claim that we have completed the reorganization.
No, or maybe I meant restructuring, that something that you were saying last time, that we were exploring along with our partner KWE and along with the parents, something on that front. I meant that.
So that basically is right now the status is the same that we had given to the stock exchange the last time, stating that we are kind of considering some restructuring, but there is nothing that I can talk about right now.
Okay. Thank you, and all the best.
Thank you. The next question is from the line of Alok Devra from Motilal Oswal. Please go ahead.
Good evening, sir, and congratulations on decent numbers. Sir, just wanted to understand in this quarter we have seen nearly a 50% plus growth in volumes, and revenues also growing by a similar kind of a number. So there has been no realization growth. Is that primarily because of some change in the mix of shipments handled? Any color on that?
So thank you for the question. I just responded to the earlier question stating that it is a combination of the yield tonnage that has brought about the growth on the revenue. And of course, this combination coupled with optimization and cost has brought about the growth in the gross margins also. As far as the mix is concerned, if you're talking about the vertical mix, we haven't yet seen success on the mix change because we are growing our KEA faster. However, the focus is definitely to grow the SME and retail. Having said that, I think our sales team has done a phenomenal job in increasing the KEA yield for us.
Sure. And also just wanted to get a sense on the how the the volumes have shaped up specifically in June and July, because some indicators are suggesting that while April and May were pretty strong, June and July were slightly slow. Any views on that?
No, not really. So for us, there has been an increasing trend month after month. We haven't seen any slowdown really happening. Yes, due to certain market conditions, in the month of May there was I would say increase which was more than what it would have been under normal circumstances. This had to do with certain competitors, etc. But otherwise, we have not seen a change.
Sure. And so, is it possible to just quantify that out of our revenues, how
even when you are reaching on time, everything is good. But if you are not reaching on time, or if you have damaged some shipment, how upfront and trustworthy are you as a service provider to the end customer is extremely important in today's day and age. I have said this before and I will continue to say this. I don't know why there is a perception that many players are entering the B2B express logistics business. I have not seen a sixth national player beyond the five players that has come into this B2B business.
Not really, so sorry, not really entering the business, more of like going more, I would say, aggressive on that side, like focusing more on growing that. For example, a player which was majorly an B2B express player is now growing faster in the B2B express, surface express business. And similarly, we have a PE funded player which is listed now and is under a broader group, like it has the deeper pocket to actually go aggressive there. So in that sense is what I meant.
No, correct. So that's what I'm saying. There are five clear national players in the B2B business, and the two that you spoke are within those five. Unless you have a good, deep, large network, you are not going to be able to be playing in the B2B business, and it takes a lot of time and money to develop a network which is reliable and dependable in a country like India, especially in the surface network region. Coming to the second question, if I followed your question correctly, you asked whether Gati is going to be in the contract logistics. Was that your question? What exactly was your question? Sorry, can you repeat it?
So it was more to do with in case Gati enters the contract logistics business in the future. So I just wanted to understand the kind of return profile in the contract logistics business vis-a-vis the current B2B express business that we are doing.
Oh, okay. So as you know, the contract logistics business basically has two elements to it. One is warehousing, the other is distribution. A pure warehousing contract logistics business would give a profile of anywhere between 10 to 15% EBITDA margin, and once they get into distribution, that could go down to somewhere between 8 to 10% from a pure contract logistics business. For Gati, we still have a small portion of contract logistics within us, which we call the supply chain business in our parlance. As such, I have been now in Gati for a year, and I have been concentrating on making sure that our express logistics, which is basically the bread and butter for Gati, comes back at the service levels that are expected by the customers. Once that happens, we will definitely be looking at getting into contract logistics in Gati, because I strongly believe that if you have to be a fulfillment player, you have to store and distribute the finished goods.
Okay, understood, sir. And like this would also involve considering all cargoes contract. I'm not saying whether it will happen or not, but even we are open to that also. All cargoes contract logistics business, taking that up.
Yes, that is always explored.
Okay, thank you, sir.
Thank you. The next question is from the line of Nidhi Babaria from Envision Capital. Please go ahead.
Yeah. Hi, sir. Thank you for taking my question. I just wanted to ask on gross margin side, even on a Q-on-Q basis, we have increased our gross margins. I know it's a combination of both volume and value. I just wanted to know, is there any, like, despite having a extremely higher diesel cost in this quarter, like, which was almost 100 rupees plus, how were we able to manage in this specific quarter? And going ahead, what would be our target for FY23 and 24?
Sorry, I did not get your question. What cost you said? 100 rupees what?
Diesel prices in this quarter were above 100 rupees for the entire quarter, which was highest ever. Now it has come down, but despite having the highest diesel cost, how were we able to manage these type of, we were able to improve our gross margins on a Q-on-Q basis?
So I've said this before, a large proportion of our customers are on DPH, which means that they are on a diesel formula. When diesel increases, that portion of the rate goes up, and when diesel goes down, that portion of the rate goes down. And I think the sales team has done a fantastic job of making sure that the proportion of DPH that we now have with our customers, which is automatic, more than covers our main direct cost, which is the line haul cost. That is the trucking cost that we have, because that is where, from an expense side, the DPH applies to us. So that way, our contracts cover that DPH for us, and therefore that should not have any negative impact, and neither will it have a positive impact when the fuel goes down. So that has been well covered by our sales.
And what portion would be direct cost to our total revenues, if there is any rough breakup?
So our network cost to our revenues would be about 45%.
Okay. And going ahead, what type of gross margins do we target for 23 and 24?
So a good gross margin for 23, which I've said before, would be in the vicinity of 29%, and moving forward, we increase that to 32%.
Okay. Thank you.
Thank you. The next question is from the line of Dipesh from Equirus Securities. Please go ahead.
Sir, on your tonnage growth in the surface express business, that seems better than the industry and also the competition. So just wanted your thoughts on the same, that if you have gained any market share, and is it sustainable?
So I think one of the things that I have always said before also is that the good thing about Gati is that every single vertical of ours, we have at least 7 to 8 of the top 10 customers of that vertical as customers for ourselves. Basically, our share of business in those customers was low when I came into Gati. What we have managed to do is, we have managed to increase the penetration with the same customers and get a much larger share from them. These are customers who had give to our staff, which we do in the month of April. The YOY, of course, was basically reorganizing and bringing in good talent into the organization, which I have told even in my last quarter that now we have completed the talent acquisition that we had set out to do.
Got it, sir. This is more of a sustainable number that you see for the remaining quarters.
Yes, absolutely.
Okay. And lastly, sir, the asset held for sale on the balance sheet, right? The land and buildings that have been completely sold off. And also, what is the update on the fuel stations?
I will ask Anish to answer that question.
Yeah. So the total asset held for sale, is approximately around 140 crores. So we have a clear visibility for almost like 55% of the total AHF, which is approximately 83 crore rupees. We have realized part, and part money will come in Q2. So that's why, in the P&L account, you see an exceptional gain. In some of the properties, we got gain. In some properties, we had to kind of write it down because realization is much lower than actually what is carrying, the value which you're carrying in the books. With respect to the fuel station, yes, there is a progress which is there. So we're just awaiting the approval, from the authorities. So once the approval comes in, and I think we should be in a position to kind of, sell that fuel station. So I think Q2, Q3, we just need to wait and see. And we are hopeful we would be able to kind of get this sale materialized, in this financial year at least.
Sure. So just to clarify, you said 140 crore was the asset held for sale, out of which 83 crore has been realized and remaining will be still pending, right?
Yeah, 83 crore rupees food we have not realized. We have got a clear visibility where we identified the buyer, we have entered into a sale agreement, some got disposed of, some in the process of selling up, where we have entered into AOS agreement for sale. So most of the money would get realized in Q2.
Got it, sir. Thank you and all the best.
Yeah.
Thank you. The next question is from the line of Pranay Roop Chatterjee from Burman Capital. Please go ahead.
Hey, good afternoon. Am I audible?
Yes, you are.
Thanks, Bill. So just a couple of questions. There was an interesting slide on your presentation which essentially was talking about, which is slide 18, old hub versus the new hub in Faruk Nagar, and then you have mentioned a whole lot of features that you have introduced. So I just wanted to understand, when you have replaced these three warehouses, right, which are 84,000 square feet, into one warehouse of about 1.13 lakhs, can you share any metrics or any quantitative guidance on what are the improvements? Because qualitatively we understand from channel checks and industry that service quality has improved in North India. But could you provide any metrics like that percentage turnaround or any specific lines, how much revenue growth have you seen? It will help us understand in the future hub expansions, what kind of gains we can expect.
So, to give direct attribution of revenue growth for one hub becomes extremely difficult because, it's a networked business. What does really tend to happen is that customers who were giving us a lesser share for North India have definitely started giving us more share of their business for North India because they now believe that our service has improved in North India because of the super hub. What has really helped us is the 89 docks that we have in Faruk Nagar, right? So when we had three different hubs, basically those three hubs put together had about 40 odd docks, and we could only unload trucks, and that too partially from one hub to the other hub till we got that. So the time for loading and unloading was exponentially higher than what it is now. So for our own business partners who are our trucking partners, they all love it when their trucks are rolling on the road with goods rather than sitting at the hubs to get loaded or unloaded. because they can then earn more out of it, and if they earn more, we also, our cost optimization takes place. So I don't know how to give you an absolute number by one hub, but definitely the turnaround time of the truck has reduced, and it has reduced substantially for us. Also, the efficiency of being able to load and not miss out something because it was lying in 3 different places earlier, now all in one systemized hub, is far more better than what it was earlier. So that's all I can say right now.
Got it. And most of my number-related questions have been answered, so I'll just shoot again a broad question, which might appear vague, but I'll go for it anyway. On a scale of 1 to 10, right, one of the most important factors of your transformation journey is essentially improving customer delivery quality, right? If on a scale of 1 to 10, 10 being what GKEPL was in its heydays, right, in the early part of the decade, where do you think we have reached on that scale today compared to where we were 1 year back?
So if you were to ask me where we were 1 year back, I would have said we are on a 5 on 10. Today we would be on 7, 7.5.
Got it. And largely, the large part of the improvement would have happened in North India, and we would expect more improvement in the rest of the India as hubs come out. Is that a fair statement?
No, that's not a fair statement. The improvement has happened all over India. It is not just that you increase or consolidate a hub and your entire India service improves. There are a lot of elements that went into service improvement all over the country.
Got it. Fair. Thanks. That's it for myself.
Thank you. The next question is from the line of Dwanil Desai from Total Capital. Please go ahead.
Hi, team. Phil, my question is, so if, in our interactions, you had mentioned that there were some constraints in terms of handling peak volumes at some of the locations, and the new hub in North will help remove those constraints. So if we were to grow at double-digit volume from the current quarter phase, do we see any constraint, or is it contingent upon new hub coming in, or we think that we can grow in double-digit volume even from this quarter base without, entire hub, all the hubs being rolled out?
So if I were to answer this question in 2 ways, one is if I remain status quo, I cannot grow double digits. The second answer is if I wait for the hubs to come, I will miss out on opportunity. So what we have done, especially now, because we know that we are approaching season time. As you know, season starts end of August and goes up to November, especially in our business. What we have done is we have enhanced capacity by temporarily leasing excess space wherever we found that we had choked up last Diwali. This will make sure that we don't choke up and our service level remains the same. So we have already done that or are in the process of doing that as we speak right now. We enhance capacity temporarily for the season. We don't need to do that once the new hub in Bombay comes up, once the new hub in Nagpur comes up, and once the new hub in Gauhati comes up, in those places. But in the rest of India, we will have to continue to have temporary space till the new infrastructure gets built. And that was one of the issues that Gati was facing earlier, but now we have learned through our experience, and we have already put that in place.
Okay. So second question, Phil, is on gross margin. I think if I remember earlier calls and conversations, we have told that, we kind of sacrifice some gross margin in order to improve the customer responsiveness and service level. And I think we are aiming to go to 29%, 30% margin by end of the year. So what are the levers to moving from 23% to 29%? Is it the higher capacity utilization, newer hubs, or something more?
So first of all, when you talk about gross margin, you must talk about my core business gross margin, which is the express logistics business, in which we are at 27.7% gross margin. When you see the consolidated gross margin, that is because of our fuel pumps business that comes in there.
Right.
So we are looking at from 27.7 to take it to 29%, right? So it's not from the other figure that you spoke about. Having said that, of course, there are many levers that make us increase our gross margin, and we'll continue to build on all the three levers of yield, cost optimization, and increase in volume. And we strongly believe that we are on track to hit that gross margin.
Okay. And last question is on the franchisee part. I think we have retail and SME segment that we want to tap. I think franchisee is an important part of the tapping that segment. So can you help us understand what is the current strength of franchisee for us, and how do we want to increase in next 2 years?
So today, as we sit here, and the number may not be exact, but we have around 250 odd franchisees, or maybe even slightly more. But what we are looking at doing is a twofold exercise. One is to revamp the franchisee process itself, and the second is we are looking at increasing 100 more franchisees in the next 12 months.
Okay. Got it. Thanks. That's it.
Thank you. The next question is from the line of Dhaval Shah from Direct Capital. Please go ahead.
Hello. Am I audible?
Absolutely.
Thank you, sir. Great set of numbers. Congratulations for that. Sir, just one clarity I wanted to understand. So you mentioned in terms of increasing the EBITDA margin and EBITDA absolute from here. Is my understanding correct that any incremental revenue adjusted for variable costs straight goes to EBITDA? Are we now the fixed costs are in place, or and then incrementally all goes to the bottom line? Is my understanding correct?
I would say almost correct. As we build out new hubs, there will be some incremental lease costs that will come in. But otherwise, yes, you are correct.
Okay. And secondly, sir, you mentioned about winning back the market, the business from your old customers. So the loss of business would be for those organized players, the large 5 organized players, or it would be from the unorganized side?
I don't understand loss of business from organized players.
Sorry. So I mean, the business which you won back from the customer. So your competitor would have lost that business. So
yeah, I got it now. No, definitely it is from the organized players, because those are customers who would work only with organized players.
Achha.
The unorganized players are all the new businesses that we are winning.
Okay. And sir, where do you see the best visibility in terms of growth, in terms of the end industry?
So this is always a catch-22. The key accounts basically have a lot of volume, right? So when I win even 10% of a key accounts volume, I have to win at least 10 SME customers and 100 retail customers to get that kind of volume, right? So while our focus definitely is to increase the SME and retail faster, but there is no such directive in the organization to say stop adding key accounts. So key accounts is a separate team, SME is a separate team, and retail is a third team. We have 3 different sales teams. And while we haven't said to our key accounts team, please stop or reduce the business, because that's not the intent, we as an organization are focusing our efforts on how we can hasten or fasten the effort on increasing SME and retail business through various modules, as I responded to one of the earlier gentlemen in the question.
Yes, yes. In terms of profitability, would there be a large variation between the retail, the SME, and the key accounts?
In terms of yield, definitely there would be a large variation. Profitability again depends from customer to customer. Some customers give us dense load, some customers give us volumetric load, and each of these combinations determine the end profitability for us. But from a simple yield perspective, definitely a very large difference.
Understood. And sir, last question will be in journey of growth over next 3 to 5 year period. How vital is Air Express as a division for you?
Air Express becomes extremely vital, and I explained this to my own internal team many a time, that for every single shipment that we pick up in Air Express, it gives us almost 6 times the yield of our Surface Express shipment. So we should not go by sheer tonnage of Air Express that we carry, because I would multiply that by 6 and say we are so large in the entire express business. Yes. So yes, to answer your question, it is extremely important for us. Our first benchmark is to hit the 10 crore mark per month in Air Express. As you have seen, we have consistently now hit the 6 crore mark, and we will definitely be increasing that quarter after quarter.
So, sir, so do you see any difficulty in getting the space at the belly cargo at the time which you want, like the time slot? Because the way we understand, the morning slots are very expensive, and then as the day passes, the rates are different. So, so how would you look at it in terms of managing profitability, given we'll be using the belly cargo?
Yes, there are various combinations available to us because different airlines have different capacities, different rates, and different service levels. It's literally an algorithm that one has to run to determine if I have this cargo today, which airline should I put it on, and at what time I should put it on, to get me the best service and the best profitability. There is also a devil over here called the co-loader, and sometimes when you don't have adequate tonnage, you also use the co-loader.
Okay.
A combination of these gets you your service as well as profitability.
Yeah. And sir, in the quarter reported, in the June quarter, we would have seen some impact of a steep increase in ATF prices on your EBITDA. So do you think that would normalize going forward now the prices have started with correcting?
So one of the good things in the air business, all air customers are 100% linked to fuel. Okay. Unlike the surface business, where I cannot say all are linked to fuel.
Okay.
And therefore, for us, as the fuel price increases, our revenue increases in the same proportion, and if it reduces, so does the revenue in the same proportion. The volatility in air turbine fuel prices is far more than in
diesel, yeah.
And basically one cannot even predict, although you and I read the same Economic Times every day.
Yeah.
I think it is very difficult for us to predict what's going to happen with some lady going to Taiwan and some gentleman going to Russia, right? So
yeah. No, great, sir. Great. So thank you very much for answering the questions, and good luck.
Thank you.
Thank you. The next question is from the line of Ronald Sioni from Sharekhan. Please go ahead.
Yeah, good afternoon, sir. Congratulations on a good set of results. Sir, I wanted to understand this gross margin a little bit because, as you said that we have been winning customers back and mostly key accounts. So, but the mix hasn't changed versus, say, last year or sequentially. Also, if, you are winning those accounts also, the yields would be a little bit lower. So maybe margins a bit lower. So, both things are not adding up with respect to the increase in gross margins you are having, unless and until you have shut down some routes for those accounts and restructured or replaced with another routes.
So maybe I'm repeating myself, but gross margin is a combination of both yield, volume, and the cost optimization. What we have done over the last 1 year, as we have first concentrated on increasing and bettering the service levels for our customers, whenever the customer comes up for renewal, we have been successful in increasing our yield, even if it is a key account, which we are now confident because our service has gone up, and therefore we have been able to increase the yield in our key accounts also. At the same time, there is huge optimization of network costs and pickup and delivery costs. That is a continuous process, and that has happened and continues to happen, and therefore the gross margin percentage has gone up to 27.7%. This will continue. Yes, you are right. In spite of the mix remaining almost the same, we have been able to increase our gross margins, and we are very sure that as we focus on the SME and retail segment more and more, this mix will also change.
Okay, sir. Thank you very much, sir. Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I now hand the conference over to the management for closing comments.
So I'll take this opportunity to thank every one of you for joining the call. We will keep updating the investor community on regular basis for incremental updates on your company. I hope we have been able to address all your queries. For any further information, kindly get in touch with us or Strategic Growth Advisors, our investor relations advisors. Thank you once again and stay safe. Thank you all.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes this conference call. Thank you for joining. You may now connect your line.